Hello and welcome back to Fin for Beginners. Today, we're tackling a challenging but exciting topic in the financial world: derivatives. Picture derivatives as special contracts. They're worth hinging on the performance of something else, be it an asset, index, or interest rate. The unique thing about derivatives? They let you trade based on the value of these underlying entities without you actually having to own them. Common examples of underlying entities include stocks, bonds, commodities, currencies, interest rates, and market indexes. The most well-known derivatives are futures, options, swaps, and forwards. Let's break them down. Futures and forwards, these are contracts that lock in the price of an asset for a future transaction. Imagine you're a farmer betting on the price of wheat a year from now. With a futures contract, you can lock in today's price, mitigating the risk of price fluctuations. Next, we have options. These are contracts that give the holder the right, but not the obligation, to buy or sell an asset at a specific price before a certain date. Think of it as reserving a hotel room. You have the option to stay, but you're not obligated to. Swaps, on the other hand, involve exchanging cash flows or other financial instruments between two parties. For example, swapping a fixed interest rate for a variable one. These are just a few examples of the types of derivatives you might encounter. Derivatives are used for hedging risk, speculation, and getting access to otherwise inaccessible markets or assets. Now let's unpack that a bit. Firstly, hedging risk. Picture an airline company. They need fuel, lots of it, and the price of fuel can fluctuate wildly. To protect themselves from a sudden spike, they might enter into a derivative contract that locks in the price they'll pay in the future. That's hedging. Next, speculation. Some investors use derivatives to bet on the future price of an asset. If they believe the price of gold will rise, they might buy a derivative that will increase in value as gold's price does. But beware, speculation can be risky. Lastly, gaining access to otherwise inaccessible markets or assets. Some markets might have high barriers to entry, or an asset might be too expensive to buy outright. Derivatives can provide a more affordable way to gain exposure to these. For example, an investor might use them to protect against price movements in a volatile market. While derivatives can be powerful tools, they come with high risks. These financial instruments are not for the faint-hearted. They are complex, intricate, and demand a deep understanding of the financial markets and the underlying assets they represent. Imagine trying to control a high-speed vehicle without proper knowledge of the gears and brakes. That's what dealing with derivatives without a firm grasp can be like. The potential for significant losses is another major risk. The use of leverage in derivatives can magnify gains, but it can also amplify losses, sometimes even exceeding the initial investment. Yes, you heard that right. You can lose more than what you put in. This is why it's so vital to have a solid risk management strategy in place when using derivatives. And let's not forget about market risk. The value of derivatives is directly tied to the performance of the underlying asset. If the market doesn't move in your favor, you can find yourself on the losing end. So remember, it's crucial to thoroughly understand the derivative and the underlying asset before diving in. And that's a wrap on derivatives. We've lifted the veil on these complex financial instruments, explored their types, and discussed why they're used. We've also warned about their risks and the importance of understanding them fully before diving in. Remember, knowledge is power in the world of finance. So, always educate yourself and consider seeking advice from a financial professional before stepping into the realm of derivatives. Stay savvy, and I'll see you in the next video.